This month, no changes will be affected to asset allocation, although discussion centered on improved valuation in some equity markets. The pullback witnessed in equities in the second half of the quarter has brought PE ratios back from the brink of being very expensive. At the same time, good earnings over the previous period has also helped. That's Q4 of last year. At the beginning of this year, PE ratios were clearly too elevated. This is not uniformly the case any longer. However, we failed to spot any obviously undervalued regions. Nonetheless, the view is that given additional expected volatility and some fresh uncertainty about global trade policy, it's best to hold off adding to additional equity for now. We point out that we remain strongly underweight Japan and that this position is reinforced by rising political uncertainty there. On trade policy, we take care to avoid making outright bets as the situation is just too fluid and unpredictable. In fixed income, the rise in long-end rates has been a detractor to performance. It has been the case that the shorter-dated bonds have been the stronger performers. Again, despite more favorable potential entry points being available in long-dated paper, we prefer to remain positioned for some additional increases in rates. Selectively, there may be some opportunities, but at the asset allocation level, we retain our cautious positioning. While credit spreads have widened to some extent over the quarter, the default outlook is still very benign, given the very good, strong economic growth that we see, the good environment. After the recent Fed meeting, we maintain our view of one hike per quarter for the rest of the year. After some initial jitters, it looks as if the market is coming around to the view that a gradual normalization in both rates and inflation is not necessarily a bad thing. It is a normalization of monetary conditions and not a shock that will have serious implications.